Lobo Tiggre returns to the show. He is the editor of the Independent Speculator.com. We can check out his work in the link down below and watch our prior interviews in which we discussed the possibility of a hard landing. Well, according to him, this possibility is now becoming more of a reality. We'll be talking about what's next for the economy, what's next for precious metals, base metals, and investment implications of the elections. Welcome back to the show, Lobo. Good to see you as always.
Thank you, David. Always a good conversation with you.
I enjoyed our last conversation in which you talked about a hard landing. You know who doesn't agree with that? Janet Yellen. Take a look at my screen here. I have a CNBC article pulled up. You were talking
Sorry, I found
about
your screen really distracting, David. There's a Disney advertisement with a bunch of scantily clad women on there. What is the age demographic of Disney these days? Sorry.
what are you talking about?
The banner at the top, before you scroll down. Look
Oh,
at
that's
that.
is that the Kardashians?
Oh, sorry. I see Disney. Okay, no wonder. All
Anyway,
right.
let's continue the CNBC article I have here. You told me about this offline. Yellen on the U.S. economy. She says the U.S. economy remains strong. We're seeing less frenzy in terms of hiring and job openings, but we're not seeing meaningful layoffs, Yellen said at the Texas Tribune Festival in Austin. I'm attentive to downside risk now on the employment side, but what I think we're seeing and hope we will continue to see is a good, solid economy. I'll leave it at that. A good, solid economy. Any indicators you're looking at that may support or refute that statement?
You left out one bit. She says, I see no flashing red lights in that interview, which struck me as, particularly myopic. The only way you could not see those red lights would be with lead blinders on. It's amazing. It's also interesting. This is a classic case of Neil Stephenson defined bullshit, where what she said isn't actually untrue. Like there isn't an actual lie in there, but the pieces of truth and the fragments of truth mixed into that statement, with the bold part being a hope, and a hope can't be wrong, right? You can't disprove what she hopes, right? So it's completely misleading, with little kernels of truth being, the breadcrumbs leading you down the wrong pathway. Anyway, so yes, there's plenty of red signs flashing out there. Look at commodities. They are signaling recession. Look at oil. Look at Dr. Copper. They're signaling recession. Look at the labor market. We don't just have cracks in the labor market. We have widening cracks. We now have a trend on multiple measures towards trouble in the labor market. And the laborer / consumer has been that pillar of American exceptionalism. It's been what has held everybody's hopes up, that America will be spared the trouble we see in Europe and Asia and around the world. And so that's not just cracking, like that is starting to crumble right now from the data we're looking at. And people say, oh, it's still historically low unemployment rates. Well, but that's not true. They changed the definition, what we now call unemployment U3. We used to call it U6. Peter Schiff does a great job of explaining this, my fellow Puerto Rican, before 1994. So to talk about this pre-94 numbers that's being comparable to the current ones, that's misdirection. And again, whatever the absolute number is, you can say, oh, it's only 4.2, 4.3. That's not so bad. The point is it's curving up. And every time it does that, it does it going into recession. And, I don't know, you and I talked the last time we had a chance about the Somm rule and how Claudia Somm herself is now backpedaling that. Of course, mainstream economist, makes no big surprise to me. But the long version of the Somm rule is what I call the Gundlach indicator, which is the 36-month, the 3-year average versus spot unemployment, if you will. And when those lines cross, that has a perfect track record of calling recessions going back 80 years. 80 years. And importantly, it's not a leading indicator like a yield curve disinversion, which is another buzz point in today's financial media. The Gundlach and Somm indicators are coincident indicators. They're saying that we're in recession now, and the NBER or whatever won't recognize it for another year or something, kind of like those 818,000 jobs that disappeared a year later, right? We'll get revisions and recognitions later after the fact. But there is absolutely, even if you're on, Team Biden, Harris, or whatever, if you're at all objective, if you're going to look at the data, you'd have to say that there are at least some red lights. It's not happy, happy, joy, joy. Heck, we just had another discount chain file for bankruptcy this morning. It was Big Lots this morning as you and I speak. So if the people on the bottom rungs, the people who shop at discount chains, don't have enough money to go shopping, that's a huge flashing red light. Sorry,
How
I
much?
went on, but there's so many indicators. I just
So
had to
that's
speed along
okay.
with you.
I want to narrow down on some of these indicators, but broadly speaking, how much of what Yellen said, what we just talked about, is political, meaning she wants to assuage the population before the election?
I would say 100%. I think that's her job. I mean, she's Treasury Secretary. What does that mean? Does she go around designing dollar bills or turning the crank on the printer or pushing the button to electronically create them? Nah, the, you know, that's not her job. Her job is to tout the administration's agenda. And I don't say that particularly of her. I think that's the job of anybody who's Treasury Secretary. Does she have brilliant economic insights to contribute to the White House and help them make their decisions? I don't think so. I think she follows orders the same way any of her predecessors did.
Before we continue with the interview, I'd like to tell you another way that investors can be positioned and exposed to the precious metals. Well, with mining stocks, with gold prices hitting new all-time highs, investors are looking for the best ways to gain additional leverage exposure to the yellow metal. Now, one excellent option is today's sponsor, Radisson Mining Corp, located in Quebec, Canada. With its new president and CEO, Matt Manson, at the helm, Radisson is advancing its O'Brien Gold Project, one of Quebec's highest grade, underdeveloped gold projects, towards production. Surrounded by some of the world's best gold miners with underfed mills, including Agnico Eagle, Eldorado Gold, IM Gold, and Wesdome, and an MOU with IM Gold to evaluate mine material processing at its nearby Doyen mill, Radisson is now one step closer to gold production. Shares of Radisson trade on the TSX Venture Exchange in Canada under the ticker symbol RDS, and in the US on the OTCQX under the ticker symbol RMRDF. Find out more at radissonmining.com, link down below in the description. I'm hearing as well, different arguments as to what the Fed should do come next week. So it's baked in the cake, I think, market consensus that we're getting one cut, but some people think that a cut is dangerous. We don't need a cut. We don't need to bring the interest rates down lower than what it currently is, which historically speaking is just average, by the way. We have 4 or 5% Fed funds rate in the past, right? 0% is not average. And inflation's been coming down already on its own without the Fed having to cut. So what's your view?
Well, should is kind of a loaded word. I think what they should do is all quit, close up shop, and tell people that the government has no business managing interest rates, that the market ought to handle it. And again, Gundlach's a smart guy, and he points out that if you look at it over the long term, the Fed funds rate tracks the 2-year. It really, with some wiggle room, and they try to massage, and their toolbox includes the jawbone, and they're trying to steer the great ship of state and all that stuff. But at the end of the day, they don't actually control interest rates. This is a myth. And Bernanke, I think, was the most egregious in promulgating this myth. It's not like there's a button in the Eccles building where they set a dial and hit it. Okay, 2.5, 0.5, or 5.5. They intervene in the marketplace. They buy and sell in the marketplace to achieve their goals. This is not a button. It's not a setting. They can't, just decide this is what it's going to be. If they intervene in the marketplace and the market is having none of it, then you get something like the gilt crisis that we saw in the UK a while back, right? The market can rebel, and that control is not absolute. The government doesn't actually have that power. So if they are wrong enough, then they are forced to change course, the famous pivots that we see. So this isn't just tinfoil hat theory. Just look at the facts on this. So anyway, what should they do? If I was a mainstream economist, I would probably be in favor of cuts. I mean, it looks like they're beating inflation. There are worrisome signs. The unemployment issues, or the employment issues that I brought up, there are plenty of red signs. And so from the mainstream perspective, I do think that, cutting, I don't think they need to go with a 50 right out of the gate, but to at least do 25 and say, yes, we're paying attention to the economy. We hear you, workers. We're going to help you out. I think from the mainstream perspective, that would be the right thing to do. The reality is, I think, though, and I think you've spoken with Lynn Alden and you're familiar with her fiscal dominance thesis. I think she's really onto something there. And the reality is that fiscal dominance argues for more intractable inflation ahead. I mean, it really is premature to declare a victory on the inflation fight. Remember, close enough to 2%. Well, when it was less than 2%, it was an emergency. We had to do more because we were, 0.5% below our ideal target. Now we're, depending on your measure, you're roughly 1% or 50% above the target, and oh, this is an emergency. We need to cut. Right? So it's all nonsense. They should get out of the business. If they're in the business, probably they should raise, given mainstream economics. Given reality, actually, I think they should be tighter, higher for longer, because I do think that fiscal dominance that I'm referencing will come back into the play. I don't think inflation is beaten. Both candidates are promising to spend money like, well, I think it would be a disrespect to drunken sailors to make that comparison. But these outlook is highly inflationary still. So I think the Fed should put the economy into recession from a more realistic perspective. They should hold higher for longer. And yes, that will cause pain. And maybe will cost somebody the White House. But that's what they should do if they're trying to bring the economy back into balance.
But they're not going to do that, is what you're saying.
No chance.
Let me show you. Well, let's talk about inflation now. I'll bring up two indicators that may be contra to each other. We'll see. I'll get your take. Indicator number one, this is from Bloomberg last week. U.S. job openings fell in July to the lowest since the start of 2021, and layoffs rose, consistent with other signs of slowing demand for workers. Available positions decreased to 7.67 million from a downward revised 7.91 million reading in the prior month. The BLS JOLTS showed on Wednesday. The figure was lower than all estimates in the Bloomberg survey of economists. So yes, lower job openings than consensus estimates. The article also points to the fact that it's coinciding with higher unemployment and greater difficulty in finding work overall. I think this is what Yellen was alluding to earlier, that the labor market is perhaps slowing down or softening, but to her point, we're not seeing a huge rise in layoffs just yet. So is this that?
It depends on the industry. If you look at some of these bankruptcies, they're very large. And if you look at the tech layoffs, I mean, these are tens of thousands of jobs at a whack. And okay, in an economy with 300 million people, or 3.5 million people, 350 million people, or whatever the U.S. population is now, 10,000 or 20,000 here and there may seem like a drop in a bucket, but it keeps adding up. So you got to wonder about that. I wonder what statistics she's looking at. But to the JOLTS report, I think this is a strong, not just data point, but bucket full of data in support of my thesis on the hard landing. Which, by the way, I took a lot of pushback even from gold bugs and people who agree with me. They're like, "Yo, Lobo, you're like Chicken Little. So the sky's falling. When recession? WEN, right?" Well, I think it's starting to look like, it's happening. It's happening this coming quarter. It's the brown stuff is starting to hit the fan. And the JOLTS report, a couple things there. One, not only did it miss expectations, that's not a big surprise. I don't know who Bloomberg polls for these things. They're consistently wrong. I think they ought to have Peter Schiff on there, not to plug my fellow Puerto Rican too much, but if they included him in their polls, at least the range of outcomes in the poll would include something quite different, and they wouldn't be so completely wrong all the time. But anyway, so the missed expectations are a big deal. The revisions are perhaps an even bigger deal, and we're seeing this. This isn't new. We if the science of collecting and estimating statistics on a large population is imprecise, you're going to have errors, you're going to have noise, you have to, make some guesses. I understand that, right? It's either that or just close your eyes and go home. I understand that. But if you're doing it honestly, your mistakes are going to sometimes be to the upside and sometimes to the downside, right? It's a mistake. It's random noise in the system. Sometimes you'll overshoot, sometimes you'll undershoot. But the revisions are always in one direction. In the last couple of years, maybe not every single time, but it's like 49 out of 50 or something like that. So I think these revisions, it's starting to get so egregious that even, again, the talking heads on mainstream financial media, when almost 1 million jobs disappeared, that forced people to pay attention to revisions. Even then, there were some people trying to dismiss it as, oh, it's not a big deal. But you subtract 818, that's like almost 70,000 jobs a month. So you subtract that from your 110 or 145 or what have you, or even your 200s, that puts you at just barely a level to keep up with the population growth. So this has been a game changer for what all the labor data has meant for the last year. And the JOLTS revisions are in there. The claims, first-time claims revisions, always in one direction. So I really think that's the important thing is, A, pay less attention to the initial press releases and more attention to the revisions. B, understand that the system is being gamed. And C, the trend is saying that, tinfoil hat Lobo was right about the recession.
Yeah, so labor market revisions down, you're right. However, GDP revised upward. So U.S. economic growth revised up solid 3% annual rate for second quarter of 2024. This is PPS, but a lot of articles on this, right? The U.S. economy grew last quarter by a healthy 3%, up from what was initially reported, which was 2.8.
Yeah.
Now, slight revision upward doesn't usually happen, and we have to discuss that because I think good news is underreported. So let's talk about that. Yeah.
Yeah. So I'm not saying that there is no data that goes against me. I mean, the last week the initial claims dropped. And we'll see what the revisions have to say, but last week they dropped. So that's contra Lobo. I'm not saying that all of the data supports my view. I'm saying there's plenty of it that does. At the very least, the people who are saying there's no data to worry about, that is absolute misdirection. I think there's a lot of data that says that I'm right. And the GDP, I think on a fundamental methodological level, the whole idea of GDP is flawed. But even if you're going to go there, there's a clear question of who watches the watchers. If you had some impartial organization, maybe, I don't know, if there was some impartial organization that produced those numbers, I'd feel better about it. But even there, part of what goes into GDP is the CPI. And that, I think anybody who goes out into the real world, goes shopping or looks out the window and sees what's going on Main Street, has a pretty clear sense is wrong. So if CPI is wrong, GDP is wrong, and that's even accepting that GDP is a sensible number to look at to begin with. So I drive down Main Street, I look at the economy. It's my subjective sense, but it's so strong that I discount the GDP numbers. And by the way, not only do we get like quarter revisions, we get a final right after the third point, but then a year or two later, they can go back and say, oh, you know what? We're revising them again. Just like the 818,000 jobs that disappeared. That was after final jobs numbers had been set in, when they look back later. So who knows what this number will be when we look back on it, when the final, let's say 3 or 4 years from now, and we look back on it.
All right, let's bring up inflation now. I was kind of alluding to downward inflation pressures because of the weakening job growth that we've seen. But let's take a look at this. This is the M2 money supply from the Federal Reserve. If you just take a look at my screen here, I'm going to change it to annual percentage change. So percentage change from year ago. And what we see here is that on an annual percentage change basis, it was declining all throughout 2021 to last year. And now it's been, growing in positive territory. Is this signaling the return of inflation, you think? If you take the view or the theory that the money supply drives inflation?
Yes. I mean, there's the old Milton Friedman thing, always and everywhere, a monetary phenomenon. And by the way, go bugs only want to hear so often, yay for my side. But when that line was going down, I was pointing that out. I said, look, you guys, if you're going to say inflation is always and everywhere a monetary phenomenon and the money supply is decreasing, you have to recognize that. You have to say that that is a deflationary factor. Doesn't mean necessarily we'll have deflation, but it is a push in that direction. As the various vectors of force here, that is a downward push. So it is very significant to me that's turned around, long and variable lags. Inflation doesn't turn the moment the money supply does. If you think about the logic of how that works, you create money, you pay somebody, some government contractor, they go out and buy bread and buy gas, it moves in waves out through the economy. It takes a while for the increases in money supply to show up in prices. So long and variable lags, I'm not going to say when that one's going to start showing up, but it's been going on for, I think, more than a year now. And, it the trouble is nothing else is always equal. Like if we could somehow freeze everything else and just measure, okay, when does that kick in, that increase in money supply? It would be interesting. But at the same time, we have, an election going on in the US, which, as H.L. Mencken famously defined, is an advanced auction on stolen goods. Both sides are promising everything they can. The kitchen sink, the two chickens in the pot, all that stuff is on the table right now. Austerity seems to have been deleted from the political vocabulary around the world almost. So you've got that going on. You've got the Fed thinking that it controls the economy and pivoting to looser monetary stance. That's inflationary. You've got, the green agenda and all the spending for that. That's inflationary. Oh, by the way, it's not just the spending for that. It's also making energy more expensive. That's inflationary. But ultimately, it all comes back to the money supply. This all has to be paid for in one way or the other. And, what the debate now is who's going to be least bad on the tax front, right? There's nobody who's a tax hawk out there. So how is that going to be paid for? It's not going to be with, much higher taxes. It's going to be money printing. That's inflationary.
Well, speaking of paying for things, this is the take a look at this article. Former President Donald Trump's economic proposals would increase federal deficits by $5.8 trillion over the next decade, almost 5 times more than those of Vice President Kamala Harris, which would add $1.2 trillion, according to a new pair of studies from the nonpartisan Penn Wharton budget model. So, according to their model, Trump would be, I guess, worse for the budget deficit, but both candidates would mean more debt, more deficit, more spending. What's your reaction to this? How would that impact inflation?
Well, I've written about the wrong way Corrigans of modern economics. Remember, the mainstream models, these models, stagflation can't even happen. Like inflation is not about money printing, has nothing to do with the money supply. It's about confidence, and it's about, it's a sign of the strength of the economy. So, this is why we want to tamp down the economy to try to control inflation, because they believe that inflation is a symptom of an overheating economy. So that, I think that model is simply wrong. Like the fact that these models can't encompass the concept of stagflation, which can happen and has recently happened again in some countries. We've seen something that if not repeating exactly, it rhymes a lot with stagflation that we've seen before. So we know these models are wrong. And it's no surprise when they're constantly surprised by things like, inflation going up to 9%. The mainstream didn't see that coming because money supply had nothing to do with it. And so they're projecting out over a decade. If they said, okay, in the first year, these policies will spend this much and the difference on inflation will be this much, that would be more credible. You could look at which one has the most immediate spend and what the impact of that might be. But over 10 years, it really depends on the model. And if the model is flawed, then the result isn't going to be right. Now, I don't want to go out and defend Trump's spending versus Harris's spending. I'd rather see less government spending all around. I'd rather see the private sector take care of the country's needs. But it is, in the same way, the mainstream is wrong to have this blind spot for stagflation. They're wrong to dismiss the possibility that you can grow your way out of some problems. Like that actually does happen. In the real world, if you're a business and you've got a great business plan and you may borrow money to implement it. And then if the business works, then you pay the money back and your growth. I mean, in my world, in the mining world, it's normal for companies to produce feasibility studies, go to a bank, get the money to build their mine, and grow from there. Now, many of them fail, but it's not inconceivable that you can grow your way out of a bind. And the problem is that it's not a company. A government isn't a company. You don't have that control. The other side will scuttle your plans. You may have a reasonable plan, but what ends up being reality ends up being a dog's breakfast of everybody's different political agendas. So I'm not enthusiastic about all of these, but it is, I think, logically incorrect to say that you can't stimulate an economy by less taxes, less regulation, more free enterprise, and have that produce increased growth, which actually reduces debt to GDP and other problems.
Well, here's the thing, Lobo. Both candidates, Harris and Trump, and by the way, they're debating this week, so we're recording ahead of the debate. But both candidates have promised to fight inflation and make inflation one of their top economic priorities.
Yeah,
different ways of doing it, right?
But they promised to fight inflation. Of course they do. And in the biggest spending bill in recent memory, the Inflation Reduction Act, it was a spending bill.
Let's evaluate what they're planning to do and see how effective it could be. So on the Kamala Harris side, she wants to, among other things, increase housing supply by the order of 5 million, I think, over the next coming years. She wants to provide incentives for first-time home buyers by the order of $25,000. Presumably, she wants to bring down housing inflation. On the Trump side, he wants to do several things, including drill baby drill, which is to increase oil supply, increase shale production. Presumably, if we have more oil production and demand falls because of weakening economy, we would have a lower oil price, which would factor into the rest of the economy because oil is a major input for everything, right? So, can you evaluate this housing supply and oil?
I have comments to make, but I have to say we've been talking for half an hour now, or whatever it is.
Yeah.
And I'm a due diligence guy. I kick rocks and pick stocks for a living. I'm not an economist, so I should probably caveat everything I just said about these are just my semi-informed views because the mainstream is so obviously wrong. I have to think about these things.
People like your views. It's not, yeah.
But okay, so I'm just saying that because I'm not a housing market expert. Know a little bit more about the oil patch, but these are a bit crystal ballish questions to me, but it seems to me that you're much better off reducing regulation, addressing structural issues that make housing more expensive than it needs to be. And ultimately, I do subscribe to the always and everywhere monetary phenomenon. If you're serious about inflation, stop government spending, stop pumping new money into the economy, stop lending new money into existence by monetary policy. Don't fiddle with housing or oil or any of the details. Focus on fiscal and monetary policy. Live within your means. Produce more than you spend. Create wealth and savings for investing in the future. That's the way any sensible household manages their affairs. That's the way any sensible business manages their affairs. I think governments are not exempt from economic reality. And if you do this, if you spend money to subsidize housing, yeah, you'll get more houses. But, government housing projects, why are those not happy words in most people's minds? And if you incent people who really don't have the means to get into housing, you're incenting them to make an economic mistake for their family. As any homeowner knows, buying the house is the least of your problems. As soon as you buy the house, you've got this albatross around your neck and pipes break and the neighbors sue you and the city wants to do this, that, the other, right? There's all these problems, maintenance, and it's not just the mortgage, it's everything else that comes with it. If you need help to get into a house, you probably shouldn't do it.
Okay, let's talk about
the oil side, drill baby
oil
drill,
side.
We've got cheaper oil now and the economy is slowing. If anything, so I think both policies are wrong. I think the best policy would be more of a Ronald Reagan style, get the government out of the way. And by the way, to give Trump credit on this, in the pandemic crisis, his solution, the Operation Warp Speed, was actually to get government out of the way. It was pharma companies, what do you need to do to solve this? And let's then do it. We'll get out of your way and we'll let you do it. So I would like to see more like that.
Interesting. Well, let's talk about rocks. Copper first. You mentioned Dr. Copper is signaling a recession. Here's the copper chart. Okay. So the copper chart has been on a steady decline since its highs in May. If you zoom out, however, which I'm doing right now, this isn't unlike what we've seen before in 2022. And I'm just going to point this out as a counter argument. No recession in 2023, right? So how do we know for sure
Oh,
that this is
wait, right
signaling
where
it's
those big red lines are, if you go back, yeah,
yeah.
isn't that about where we had 2 quarters of negative GDP?
You know what? You're right.
So
You
just
know what?
saying. And
Yeah,
yeah,
and then people said that was not a recession. Remember that? Yeah,
well,
because that
yeah, okay, but
you're right.
just saying. And actually, to be fair, there is something to, just 2 quarters of a print. And this is a number that I call BS anyway, right? So I didn't hang my hat on that. Also, if you were to inflation adjust that chart,
Hmm.
you would see, the part that looks lower now, like the copper still, you could say, oh, okay, it's down, but it's still up. Well, but if you inflation adjust that, it's not up as much as you think. And then and that's using CPI. If you look at the actual world of mining and what it costs to get miners out there these days and the cost of equipment, tires and things like that, the inflation is nothing like, never mind the 2 or 3% now. It was nothing. It was not like the 9% we had back then. You were seeing cost increases of like 50 to 100% in equipment and sustaining capital costs in mining projects. So, I mean, it looks like, hey, the copper's not doing so bad, but in the real world,
Yeah.
um, we need higher copper prices if
Well,
we're going to, never mind the green agenda, if we're just going to provide our civilization with this fundamental industrial metal that it needs.
what happened this year? This looked like a short squeeze, and then people took profits once it got out of control. Wasn't economic, but anyway, I'll let you comment on that.
There wasn't a headline event. I think maybe I'm not the only one who started to see the recession coming before it became undeniable.
Yeah.
And there's smart money out there that started making different decisions.
Well, I think around this time, March, news coming out of China suggested that the economy there was slowing down a lot. That may have factored that in. I'm not sure, but let's take a look at something else. I'm going to overlay this with silver. Let's have some fun here. Almost perfect correlation in the last 2 years or so. And it looks like the correlation is still somewhat holding if we zoom in. Well, let's just zoom in a bit more. So yeah, even on a 1 month basis, it's holding quite well. So is silver behaving like Dr. Copper? Is silver the next Dr. Copper? Is it Dr. Silver now?
Well, you're going to get a lot of rotten eggs thrown at me because this has been one of my contentions. Silver bulls out there. I'm not a silver bear. I'm not anti-silver. I understand that silver is the word for money in many languages. I'm in agreement on all that stuff. But my point is, you need to look at the data. Look at this, right? Oh, I was actually quite a bit more encouraged about silver earlier this year because whereas last year silver had been correlating more with copper than with gold,
Hmm.
this year, really starting last fall, when the second war or larger scale war erupted in the world stage, we
Hmm.
saw silver acting much more like gold or as a monetary asset or alternative to the dollar should. But in the last couple of months, it started looking more like copper again, and so that doesn't turn me bearish, but it makes me think. Well, in the first place, even a silver bull will tell you that in a bull market, silver lags gold initially, and then it more than catches up. So on that basis alone, there's no rush to just pile into silver right now. And then on top of that, you have this higher correlation with copper. And if copper's headed lower into the recession, it's hard to see that not being a downdraft on silver. That doesn't mean it's the end of the story for silver. Silver's done or whatever. It just means that if I'm looking to deploy cash into speculative investments, and the odds are, if not high, that silver will go lower before going higher, they're at least not high that silver will just take off right away. I mean, look at this. We've got new all-time highs, at least nominally, in gold repeatedly since 2020. And this year we've had nominal high after nominal high. We're still holding near those. And rate cuts are coming, and other things that are very bullish for gold are visibly on the docket, like in the month or months immediately ahead.
Yeah.
starting at $2,500 gold. Whereas silver, it's like the little old lady in the commercial, I've fallen and I can't get up, right? It got whacked.
Yeah, let's overlay gold with silver just to illustrate your point here. So I'm going to change copper to gold. So gold is now the bar chart, and yeah, as you can see, ever since July, basically they've been diverging. Silver's
Yes,
been
that's
trending
what I'm
down, and
saying. In
gold's been
recent
going up.
months, silver started acting more like an industrial metal. But go back to a 5-year version of that. And
Yeah, all
look
right.
what happens in 2020. They both spike down and gold comes, roaring back up and silver just I'm not looking at what you're seeing here.
Well, silver outperformed. Silver is the purple line in 2020. To your point, it went up, and then gold also went up, right?
That's
That's
uh
2020. This is August
is this
2020.
this is this a percent gain basis?
No, this is just
No.
two different
Oh,
price
okay.
scales. Yeah. You want to look
All
at
right.
it from a percentage gain basis? This is just different price scales overlaid to illustrate
Yeah,
correlation.
so
If you
they
want
so
to,
they track. If you change it to percentage gain basis, as I remember it,
yeah,
gold comes
let's do that.
screaming back up and silver never caught up. It's been 4 years now and silver hasn't caught up.
Yeah, so this is a percentage gain basis. So 5 years, if you want to look at it from, let's say, uh
Okay.
2020, right? So silver is up 97%, gold's up 80%.
Okay.
Sorry,
Well, I
99,
stopped you in
sorry,
your tracks earlier in this
97%, gold's up
interview and you said you're
93.
right. You're stopping me in my tracks. I'll have to go back and look at this again because that's not how I remember it. Um,
Well, yeah, if you take a look at it from a 5 year basis, a lot of it was this year's gains, right? So silver is the purple line and then gold is the bar chart. So gold is up from, I'm just looking at it from 5 years. I just put five
yeah.
years and then
Oh, I see what you're
65%
saying
and then
there.
62%. So yeah, roughly equal.
But the purple line is above the multicolor line there from most of that time. So that's interesting.
Most of that time. Yeah,
If
except this
all
year.
right,
If you take away this year, for example, then, well, purple line is up 80%, gold is up 50% if you stop it in 2021. Anyway, going back 5 years.
that's very interesting. All right. So according to what you just showed me, David, then I may be wrong. I may be too skeptical about silver. It makes me nervous to see silver tracking copper recently. If you're in the hard landing camp, that's bad news for copper, for oil, for nickel, lithium, everything else. Doesn't matter if they're already cheap. They can and will go lower if I'm right about the hard landing. And if silver is acting like those industrial metals, then that's a concern. This chart you're showing me, that's not a chart I've seen displayed this way before. I'll have to go back and look at this. But it says that I should keep silver lumped in the gold basket more firmly and not worry about it so much. So we'll see. To be continued on that one, David.
Well, it's a good point you're bringing up just to zoom it out a little bit more. I mean, over the longer term horizon, over the last 5 years, we're seeing more of a stronger correlation, right? If you just zoom out, but if you zoom in, for example, then that correlation kind of breaks down the last couple months or so. But anyway, bottom line, you're more bullish on gold than silver, I'm guessing, based on what you've just told me.
Based on what you just showed me, I have to be bullish on both. I'm just more, let's say I'm bullish on both, but I'm more cautious about silver.
I see. Interesting. Okay. Well, I'm glad we we made you think about your thesis today. On the resource side, any other, well, you talked about uranium offline. Let's finish off with uranium. What do you think about uranium right now?
Yeah. There's so much we could say there. I mean, I think perhaps the most interesting thing in many ways, I think nothing has really changed since the last time you and I spoke, but the sentiment in the sector has turned decidedly more bearish. And the stocks many of them have really taken a pounding. And you could say I'm talking my book. You can discount what I'm saying, or if you're disgusted with the sector because your uranium portfolio is in the red, then you can ignore me if you want. But I was right in 2018 when I saw that the uranium market was turning and heading north, and that was a long-term investment thesis. I was right again in 2022 when I said that in 2023 my highest conviction trade for the year was uranium. I'm on the record. I think you and I discussed that in the past, David. And uranium doubled in 2023. I was right in late 2023 when I said it's gone up a lot. It's due for a correction. It would be very, normal for it to correct, back down, perhaps towards long-term price contracts. And that's more or less where we are now. So I understand that it's harrowing, and I understand that if you get in at the, at a high or something like that, and you're seeing red in your portfolio, it's upsetting. It doesn't do you any good if I say, well, gee, I made a lot of money in uranium. I got in at 2018 or whatever. But it's not just that. It was when uranium was over $100 a pound, taking some profits instead of just being, on the letting the cheerleaders persuade me that it can only ever go up. I think there are lessons to be learned here. So my point, though, the takeaway is, for what it's worth, like, I'm not perfect. I get plenty of things wrong. David Lynn just corrected me on air right now. But for what it's worth,
I didn't correct you. I showed you some information, and you, being a due diligence guy and a good investor, processed the new information and kind of
live on camera. Okay.
Yeah.
So what I'm saying is, though, that my thesis for the uranium story has been, with some variability, basically right for 6 years. And I'm telling you now that I see this correction and the despair and the negativity in the market as a buying opportunity. Does that mean it can't go lower? Of course not. Does it mean it has to go up tomorrow? Of course not. Does it mean, would I personally buy more uranium stocks now, recession or no recession? Yes. The most recent purchase that I added to my portfolio was a uranium stock, not a gold or a silver stock.
Do we know if either Kamala or Trump would dramatically change their nuclear policies?
I don't think we know. I think there was some irrational exuberance about Trump in nuclear energy, and it was talked about that Section 232 inquiry, and Trump was going to save uranium mining in the United States. And he really punted on that. But it's interesting that it was, Trump's answer to that, instead of really helping the uranium miners directly, was to set up a uranium, like a strategic petroleum reserve for uranium. That was Trump's idea. Well, that was funded and implemented under Biden. And if Harris is Biden 2.0, or if Harris was the puppeteer behind Biden, who knows? It would be reasonable to think that that policy continues. And it was Trump's idea in the first place. So nobody really knows. How do you know a politician is lying? Their lips are moving. So I don't trust either of them. But both of them have actions in the past that were at least somewhat supportive. If, Harris, guilt by association, I guess. But both of them, there's reason to think that they'll be supportive. And honestly, you got to look and say, the Biden administration was very supportive of advanced nuclear. I mean, they part of their budgetary push wasn't just millions like Trump, but billions into supporting the nuclear industry. So, yeah, it would surprise me at this point if either of them turned out to be hostile to nuclear.
Hey,
sorry, by the way, I think a lot of people on the green side, they get that it's not going to happen with just the windmills and the solar panels. Like, they're not going to meet their goals without nuclear. And I think most reasonable people know that, see that, and that's a huge tailwind for nuclear energy.
Yeah, we'll follow up more on uranium next time. This is a great episode. I know people can follow you to learn more about the sectors and the stocks that you follow. So where can we follow your work?
Well, independentspeculator.com, as you said, and my quick sales pitch is always, I have a free weekly letter. If you sign up for it, you may not agree with everything I say. You may hate me as anti-silver or whatever, but at least I tell it like I see it, and I won't spam you with a flood of daily advertisements. That's one promise I can deliver on, because I hate that stuff. You get one email per week.
Okay. Well, one email per week. I'm looking forward to the next email when you're slightly less bearish on silver because of today's discussion. I'm kidding.
Let's see what happens.
We'll see what happens. Thank you very much, Lobo. Follow him at independentspeculator.com below, and we'll speak next time. Thank you, Lobo.
Thank you, David.
And thank you for watching. Don't forget to like and subscribe.